Welcome to the Explainer. Today, we're breaking down a dramatic reality check. If you follow the digital advertising space, you know the trade desk. I mean, historically, they've been the absolute golden child of growth, right? But recently, well, that narrative just hit a massive brick wall. We're going to dive right in, dissect exactly what went wrong, break down the specific numbers that completely spooked Wall Street, and try to figure out what happens next. So let's investigate exactly how this former market darling suddenly fell from grace. Here's our roadmap for today. First, we'll look at the 24% crash, then break down Q2 by the numbers. After that, we'll cover macro pressures and missteps, examine their bleak Q3 outlook, and finally, wrap up with the path forward. All right, part 1, the 24% crash, setting the scene. Let's zoom right into the immediate aftermath of that August 5th, 2026 earnings release, so we can really grasp the sheer scale of the market's reaction. Right after the closing bell rang, the company dropped a quarterly report that absolutely sent shockwaves through the market. I mean, the stock plummeted a staggering 24% in after-hours trading. It settled at just $13.39 per share. For a company that's essentially bathed in immense investor confidence for years, a sudden quarter of its value haircut? Yeah, that is a massive red flag that absolutely demands our attention. It represents one of the sharpest sell-offs in their recent history. Just think about the broader market context for a second here. This single earnings report turned the trade desk into the second worst performer in the entire S&P 500 for the year. No joke. It has raised some really serious, fundamental questions about where they're heading in the near term. Wall Street doesn't just hit the panic button like this without a good reason, which leads us right to the data. Moving on to part 2, Q2 by the numbers, expectation versus reality. Let's see exactly how the market's expectations clashed so violently with what actually happened. There is a really stark contrast here when you consider the top and bottom lines. They actually beat earnings expectations handily, reporting 34 cents per share against an 18-cent estimate. Honestly, great job there. But, in this current economic environment, the top line, the revenue, matters so much more. And focusing on that revenue, they missed the consensus by about 5%. They came in at $715 million compared to an expected $752.6 million. Investors completely ignored the profit beat because, frankly, the growth engine itself is sputtering. We are looking at a severe growth deceleration here. Just a year ago, in Q2 of 2025, the trade desk was expanding at a rapid 19% clip. Fast forward to Q2 2026, and it's like someone slammed on the brakes. That growth has virtually evaporated, dropping down to an anemic 3%. For a company whose entire valuation was built on the promise of rapid, totally uninterrupted expansion, a drop to 3% growth isn't just a slight miss. It's a fundamental shift in how their core business is actually performing. Okay, part 3, macro pressures and missteps, the root causes. We really need to figure out what caused this dramatic slowdown. So let's look at the 2 main culprits identified by leadership. CEO Jeff Green pointed out that the macro environment is acting as a massive headwind right now. A full 25% of the trade desk's business is heavily concentrated in just 2 sectors, consumer packaged goods, or CPG, and automotive. And right now, those specific industries are just getting hammered. It's a perfect storm of tariffs, rising commodity costs, and super uneven consumer spending. Advertisers in these spaces are slashing their budgets just to survive, which creates a fundamentally different and way more difficult environment than we saw even just a year ago. But, it wasn't just external forces at play here. In a surprisingly candid moment on the earnings call, Green made a really rare admission. He stated that the company, quote, didn't execute as well as we could have. Think about that. When a CEO admits to internal missteps alongside all those macro pressures, it tells us they basically left money on the table. They dropped the ball during an already incredibly difficult quarter. And that poor execution, it definitely didn't happen in a vacuum. It actually coincides directly with a major recent leadership overhaul. Consider their lineup of recent appointments: a new chief financial officer, a new chief marketing officer, and a new chief client officer. Swapping out 3 massive C-suite roles introduces some major operational instability. And doing that just months before navigating a brutal economic quarter, well, that's pretty much a recipe for the exact execution missteps that Jeff Green was talking about. Which brings us to part 4, a bleak Q3 outlook, analyst reactions. Because if the Q2 miss was bad, their Q3 guidance completely shattered whatever investor confidence was left. Just think about the massive chasm in these expectations. Analysts had a consensus prediction of roughly $805 million. But the trade desk came out and forecast revenue of at least $650 million. Not only is that wildly below expectations, but it implies a painful 12% year-over-year revenue decline. They aren't just slowing down anymore, guys. They are actively shrinking. Let that sink in. Unsurprisingly, this super bleak outlook triggered a tidal wave of analyst downgrades. Wall Street absolutely hates uncertainty, and shrinking revenues provide exactly that. Analysts at both KeyBanc and Oppenheimer immediately downgraded the stock to a hold, with Oppenheimer bluntly stating there is no catalyst until revenue accelerates. Average price targets were violently slashed down to around $24 to $25. The institutional caution here is literally palpable. And this brings us right into the financial reality of all those downgrades, multiple compression, and man, it is brutal. Before this report, investors were happily paying a huge premium for the trade desk, giving it a forward price-to-earnings ratio of nearly 90. They were paying up for that rapid future growth, but once that growth narrative broke, that premium was stripped away instantly. The forward PE compressed violently down to roughly 16. The market is entirely repricing this company, taking it from a hypergrowth tech stock and valuing it like a mature, struggling business. All right, part 5, the path forward, bull versus bear. With the stock now firmly in a show-me phase, let's explore the arguments for the company's future, because the market is deeply divided on this one. There is a serious tug-of-war happening on Wall Street right now. The optimistic bull case relies on the fact that the underlying platform is still extremely sticky, boasting an exceptional customer retention rate of over 95%. Basically, advertisers aren't leaving, they're just tightening their belts and spending less. Bulls also point to heavy investments in new tools like the Kokai AI platform and Audience Unlimited to drive a future recovery. On the flip side, bears point to the immediate, harsh reality. Near-term visibility is incredibly low, growth is decelerating sharply, and those relentless macroeconomic headwinds hitting their key clients, they show absolutely zero signs of easing out. But zooming out from all this immediate chaos, CEO Jeff Green remains incredibly steadfast on the long-term opportunity. He continues to remind investors that the global advertising market is roughly a $1 trillion industry. Despite being a giant in the space, the trade desk currently only participates in about 1% of that total market. His argument is pretty straightforward. As digital advertising becomes more complex, the value of their AI and decisioning tools will inevitably capture a much larger slice of that massive pie. So, we are left with the ultimate question. While some analysts, like those at Benchmark, are maintaining a buy rating, really hoping this is just a cyclical trough that will eventually pass, the broader market is firmly sitting on the sidelines, waiting for actual proof of a revenue recovery. So, is this 24% crash just a temporary bump in a long-term growth story, or does it mark a permanent new reality for a former ad tech darling? You'll want to watch those Q3 numbers really closely, because they are going to be the ultimate judge. Thanks for joining me for this explainer, and I will catch you on the next one.